Hello everyone, welcome to Study IQ. In this video, I will bring to you the banking awareness for the month of April. This is for third week. Let's start the video. Let's talk about the credit default swap. There is a limit for investment in debt and sale of credit default swaps by the foreign portfolio investors. So what is the limit that has been set up? So this is the only line that you need to know. Now there is a limit for the foreign portfolio investors who are investing in the government securities, the state government securities, and the corporate bonds. So what is the limit? For government securities, that is the central government security, it is 6%, right? For state government securities, it is 2%. And for corporate bonds, it is 15% of the outstanding stocks of securities for financial year 25. So what is the meaning of this? So let's say the central government issues government securities in the entire financial year worth 1000 crore. This is by the central government. Now, how much of this they can attract the investment by the foreign portfolio investor, or in other words, the foreign portfolio investors can buy what amount of the government securities? Can they buy the entire 1000 crore? No, not even close. Only 6% of it. So if the government is issuing 1000 crore, then 6% or 60 crore is the maximum that the foreign portfolio investors they can invest in, right? That is the meaning of this. So of the outstanding stocks of the securities, first, central government security or simply government security, the foreign portfolio investor limit is 6%. In the state government securities, which are issued by different state governments, so it is only 2%. And in the corporate bonds, it is 15%. It is 15%. So any of the three can be asked in the exam as an MCQ. Also, you very well know that the foreign portfolio investors, when they invest into the government securities, it comes under fully accessible route. Fully accessible route. What is fully accessible route? So fully accessible route was started by the government of India on 1st of April 2020. 2020, right? Fully accessible route. It started when? It started, and there is no restriction. There is no restriction in the fully accessible route. So this route was started so that we can attract the investment from the foreign portfolio investors. And for this route came into being on 1st of April 2020. Now let's move on to the next thing. Reserve Bank of India has imposed monetary penalty on LIC Housing Finance Limited. LIC Housing Finance Limited. Okay. Now look, RBI imposes monetary penalty on a lot of companies, but Housing Finance, LIC Housing Finance is a very big company, and that is why this is important. How much is the penalty? The penalty is 49,70,000. This is a significant penalty, 49,70,000 rupees. So why this penalty was put on LIC Housing Finance Limited? For non-compliance with certain provisions of NBFC Housing Finance Company Directions of 2021, which were issued by the RBI. And this penalty has been put by the RBI according to the Section 52A of the National Housing Bank Act of 1987. So try to remember this provision. Okay, National Housing Bank Act of 1987, Section 52A. This penalty was put under this act. And there are 4 non-banking financial companies, the license of which has been cancelled by the RBI. So there is Kundal's Motor Finance, which is based in Bareilly, UP. Nitya Finance, which is based in Coimbatore in Tamil Nadu. And Bhatia Hire Purchase, which is based in Bhatinda in Punjab. And then we have Jeevan Jyoti Deposits Company, which is based in Hamirpur in Himachal. Moving on. Reserve Bank of India has gave some guidance note on operational risk management and operational resilience. What is the meaning of this? See, the banks of today, and even the NBFCs for that matter, they both are regulated entities. They are regulated by the RBI. They are very much dependent now on third parties. So RBI wants the banks to be careful because there is an operational risk. Now, first of all, you have to understand what is an operational risk. See, operational risk is any risk that a bank faces. So bank faces different types of risk, financial risk and operational risk and all of these. Financial risk you very well know. For example, if the capital adequacy ratio is very less, it's a financial risk. Now, what is the operational risk? So the Basel Committee on Banking Supervision, they defined operational risk for the bank as the risk of any loss that the bank suffers resulting from inadequate or failed internal processes, people, and systems. So this is the operational risk. So for example, the cyber security of a bank. Now this is an operational risk, right? This is a operational risk. Similarly, we have the third party risk. If a bank is dependent on a third party company, and I will show you just now, that is a big risk if you are dependent on a third party, because the third party can do some error, but the bank has to pay for that error, right? So data entry error, for example, the accounting error, any vendor disagreements, any inaccurate client records, all of these are operational risk, right? So the man-made causes, the IT risk, cyber threats, cyber attack, any change in technology failure, any geopolitical conflict, business disruption, internal or external fraud, execution or delivery error, third-party dependency, or because of any natural cause like climate change and also, these are all operational risks. These can cause the operational disruption of a bank, and it can threaten the viability of a regulated entity, which is a bank or a NBFC. So what does RBI say? Now, this is a very big report, but I am telling you only the one that is important from exam point of view. So Reserve Bank of India says that if you want to protect yourself, Reserve Bank of India is telling the banks and the NBFCs that look, if you want to protect yourself from what? From operational risk, then you have to follow three pillars. Pillar number 1, pillar number 2, and pillar number 3. So pillar number 1 is prepare and protect. Pillar number 2 is build resilience, and pillar number 3 is learn and adapt. This is the only thing that you need to remember. Now you don't need to remember what comes under prepare and protect, but I will tell you irrespective what comes under pillar number 2, all these things, and what comes under pillar number 3 is all these things. So for example, how will you prepare and protect? That is prevention, essentially prevention from operational risk. So you should have a sound corporate governance and risk culture. Responsibilities of the board of directors and senior management, again corporate governance. Risk management, you have to identify and assess early. You have to change the management if needed. You have to monitor it and report the risk, and control and mitigate the risk. This comes under prepare and protect. Now let's come to the pillar number 2. You have to build resilience. How? So business continuity, planning and testing, mapping interconnections and interdependency, third-party dependency management, incident management, and ICT, information and communication technology, including cybersecurity. All this is building resilience. And then we have pillar number 3, learn and adapt. Do proper disclosure and reporting, lessons learned, exercise and adapting, continuous improvement through the feedback system. This is learn and adapt. So these are the 3 pillars by which you can control operational risk. This is what you call operational risk management. Now, when I was going through the PDF, something interesting I found. Reserve Bank of India says that there are 3 lines of defense which a bank has for operational risk management. Okay. So which is the first line of defense? The first line of defense is the business unit management. Okay. This is for your MCQs. The first line of defense is what? Business unit management. Which is the second line of defense? Second line of defense is the organizational operational risk management function, including compliance function. That is your second line of defense. And which is the third line of defense? Your audit function. Your audit function is the third line of defense. So just remember, there are 3 lines of defense and try to remember which one is which. So the first line of defense is business unit management. Second line of defense is organizational operational risk management function, including compliance function. And the third line of defense is the audit function. And I was telling you about the third party service providers to the bank. See, banks cannot work in isolation. Banks have to take, they have to collaborate with third party companies for what? So direct selling agents, customer care services, bank outsource them, recovery agencies, like the asset reconstruction companies, for example, they are recovery agencies, payment processing companies, marketing companies, cash ATM management, banks hire different companies for cash management and ATM management, external consultants like Ernst & Young, Capgemini, all these big companies, analytics providers cloud services providers like AWS, Amazon Web Services, legal services, banks, they depend on legal services also from third parties, IT or operation vendors like TCS, for example, Infosys, advertising partners, storage or backup providers, logistics management, and data management. So this is an example of the third party dependency of a bank. Banks depend on lot of companies for different jobs. They cannot have in-house department for all of these. Now let's come to the rate of interest that you can expect on the Government of India floating rate bond, which has a maturity period of 2034. The maturity year is 2034. So what is floating rate bond? In a floating rate bond, the rate of interest is not fixed. It will keep on floating or keep on changing with time, depending on the external situation. So the Government of India, they launched the floating rate bond with a maturity year 2034, and this rate of interest is applicable for half year. It will be applicable from 30th of April to 29th of October. So from you can say from almost 1st of May to end of October. And this will be 8%. So you will get a very healthy interest rate on the floating rate bond by the Government of India, that is 8%. Now, how do they calculate it? This is very interesting. So the 182-day treasury bill, the last three auctions, they take the average of the interest rate and they add 0.98%, which is a spread. So the last three treasury bill of 182 days duration, whatever is the auction, on that what was the interest rate that was applicable, you take the average of that and you add 0.98%, and that's how you come to 8%. So this comes out to be 8%. Now let's come to electronic trading platforms, directions which are issued by the Reserve Bank, right? So this is only a draft. So they are inviting your feedback or comments and then they will release the final draft. This is only a draft master direction. This is not the final master direction. This is for what? This is for electronic trading platforms. So any entity, okay, any entity seeking authorization as a ETP operator, if you want to work as an electronic trading platform, then your net worth has to be minimum 5 crore. Minimum 5 crore. So this is a good MCQ question, that according to the recent RBI guidelines, what is the minimum net worth for a company that wants to work as an electronic trading platform? The answer is 5 crore rupees. That is the only thing that you need to know. And Reserve Bank of India has now put a penalty on NAB Fins Limited, which is headquartered in Bangalore. How much is the penalty? 10 lakh rupees on NAB Fins. By the way, NAB Fins is a wholly owned subsidiary of NABARD. It is a wholly owned subsidiary. NAB Fins is a wholly owned subsidiary of NABARD and it is headquartered in Bengaluru. So why this penalty was put? This penalty was put because of non-compliance. Non-compliance means not following the rules and regulation of the NBFC, systemically important non-deposit taking company and deposit taking company directions 2016. And this penalty was put by the RBI according to Section 58 of the RBI Act of 1934. Section 58B and Section 58G both. 58B and 58G both, right? Okay. NAB Fins. What was NAB Fins doing? So I will tell you. During inspection, the Reserve Bank of India found that the charge pertaining to adoption of restrictive practice of forcing its customers to go in for a particular insurance company in respect of the assets financed by it was sustained, warranting imposition of monetary penalty. So I will tell you what NAB Fins was doing. Now NAB Fins has a certain customer base and they were forcing their customers to go for a particular insurance company. They should be impartial, right? But they were forcing their customers to go in for a particular insurance company. Maybe they had a agreement with that company that they will give them certain commission or whatever, but this is not allowed. So this is not allowed. So that is why penalty was put of 10 lakh rupees on NAB Fins. And here you can see the company NAB Fins, it was incorporated in 1997 and it was registered as a non-banking financial company microfinance institution in February 2015. So as of now, you can say it is a non-banking financial company microfinance institution, NBFC MFI. And it provides need and cash flow based credit services at the client friendly terms. It's a microfinance company basically, NAB Fins, and it is headquartered in Bangalore. Now let's come to a very important RBI direction. This is for the regulation of payment aggregators. Regulation of payment aggregators. What are payment aggregators? Like, they provide different types of payment services. So they are the connecting link between the customers and the merchants. How will you go and pay to the merchant? So for example, let's say you are going to Big Bazaar. You are going to Big Bazaar or you are going to Reliance Store and you have done a lot of shopping. Now Big Bazaar or Reliance Store is a merchant and you are a customer. How will you pay? You will go to the point of sale machine and you can pay by different means. You can pay through UPI, you can pay through credit card, debit card, you can pay through net banking, you can pay through, you can pay through a lot of things. Now all of these are payment gateways, but an aggregator will have everything at one place. That is why it is called an aggregator. So aggregator means it has aggregated all the payment gateways. So it will provide you different options like Razorpay. Like Razorpay, for example, right? Like Paytm. Paytm also provides their gateway. Different types of gateway. That is, it is an aggregator. So the payment aggregator can be banks also, and it can be non-bank companies also. So banks and non-banks, they all act as payment aggregator. So what are the directions? So here are the directions. There is a regulation of the payment aggregator. And again, these are draft directions. So these are not mandatory, but comments and feedback is invited. Comments and feedback is invited. And you can send your comments to the Reserve Bank of India Mumbai office, or you can email them, whatever you want. So this is how they have to work. So they have to get authorization from the RBI. They have to get authorization from the RBI. Now, who has to get the authorization? The authorization, see, banks, they provide payment aggregator services as a part of their normal banking relationship. So they do not require separate authorization from the RBI. But non-banks, they have to take authorization within 60 days. Non-banks. Now, there are some non-banks which have already got, which are already providing the payment aggregator services, right? They are already providing, and some non-banks are there which have applied, whose application for authorization is pending with the RBI. They both have to take the authorization from the RBI within 60 days. Within 60 days. Understood? Let me repeat once. So banks, they don't need separate authorization for providing payment aggregator services because it is a part of the banks. But non-banks, if it is a non-bank, let's say Paytm. Paytm is not a bank, you know, or let's say PhonePe, right? Now Paytm, let's say, has already got the authorization. Paytm is already providing the payment aggregator services. Okay, it has to get the authorization within 60 days. And PhonePe, let's say, is not providing payment aggregator services, but it wants to provide payment aggregator services. Again, it has to take the authorization from the RBI within 60 days. Now let's come to the most important point, which is the point of net worth. Net worth. So, okay, banks, you know, banks, they don't need all these things, but non-banks. Now I told you one non-banks are there who are already providing the payment aggregator services. So their minimum net worth has to be 15 crore at the time of submitting the application to the RBI for authorization, that they have to take within 60 days. And when they take the authorization within 60 days, their net worth has to be 15 crore. And by 31st of March 2028, it should be 25 crore. So at the time of asking for authorization, see, if you are a non-bank, even if you are providing payment aggregator services already, still you have to take the authorization from the RBI within 60 days. And if you are a new non-bank payment aggregator, that is, you are working as a non-bank, right? But you have not got the payment aggregator permission from the RBI still you have to take the authorization within 60 days. The moot point is whether you already are providing payment aggregator services or you have not commenced so far, your net worth has to be 15 crore at the time of application, and then it has to be increased to 25 crore. It has to be increased to 25 crore, right? 25 crore by when? So 31st March 2028. 31st March 2028. So this thing you have to keep in mind. Payment aggregator is a third-party service provider that enables the customers to make payments to the merchants. to the merchants like Amazon Pay, Razor Pay, Paytm, Cash Free, Phone Pay. All of these are payment aggregators. Understood? Very nice circular, something to understand. Now let's come to counter cyclical capital buffer. The review of requirement. Review of requirement. See, there are two terms that you have to understand. Okay. One is called capital conservation buffer and one is called counter cyclical capital buffer. Now I've explained these things in my static course in detail in the Basel norms chapter. All of these things were added during Basel norms. Okay. Now first let me explain to you the concept of capital conservation buffer. So capital conservation buffer is 2.5%. Now you know that the banks of India, the scheduled commercial banks, they have to maintain 9% capital adequacy ratio. This you know very well, minimum 9%. Now over and above this, they have to maintain 2.5% of capital conservation buffer. Why? Because they have to be ready for a bad time. They have to be ready for bad time, right? So capital conservation buffer is a mandatory requirement, and it is not something that time to time RBI will say that, okay, now you need to maintain capital conservation buffer, because you need to always maintain 2.5% of your risk weighted assets as a capital conservation buffer. This is over and above 9%. So in a way you can say that the banks, they have 11.5% minimum, 9% CRAR and 2.5% capital conservation buffer. They have to always, keep with them. 11.5% of their risk weight. 11.5% of what? Of their risk weighted assets. Risk weighted assets, right? So this they have to keep. This they have to keep, right? So why they have to keep this extra 2.5%? Because you never know when the bad times can come. When the bad times come, you should be in a position to absorb the losses. That is why. So that is capital conservation buffer. Now what happens is, sometimes the economy is booming. Economy is booming, right? There is a huge credit growth. There are periods of huge credit growth. Like for example, during festival season, people take a lot of loan. There is a lot of credit growth. They want to buy, goods, products, crackers and sweets and TV and all these things. They want to buy a million things during festivals, during Christmas, during Diwali. To give you one example, that is a period of excessive credit growth. The problem is, when there is a lot of credit growth, the banks, they are in a euphoria that, okay, this is the time to make money. But what will happen if there is a lot of credit growth? The banks, their CD ratio can collapse. The credit to deposit ratio, they should be healthy. They should be healthy. But what happens is, they compromise their deposit, they compromise their capital, and they give a lot of credit to earn more. So what RBI does is, during the periods of excessive credit growth, they always remember this word, during the period of excess aggregate credit growth, there is always a risk in the banks that they can collapse, because they will give too much credit, right? So at that time, what RBI says is, you maintain counter cyclical capital buffer. Capital buffer simply means extra money you keep with yourself. And how much is that? That ranges from 0 to 2.5% of your risk weighted assets. It could be anything. It could be anything between 0 to 2.5%. Now you know that even last year we had a lot of credit growth. If you see the credit growth and deposit growth, the deposit growth is very shallow. This is the problem with the banks these days. That is why the CD ratio is suffering. Okay, the deposits are not coming easily, because the new generation is not putting money in FD, in term deposits. They are putting it in the share market and equity linked markets to earn more. Even I have not put a single money in FD. I have put all my money in mutual funds. And I'm getting 22% return in the last 2 years. 22% average annual returns, which means in 2 years I have got at least 44%. In FD I would have got what? Hardly 7% per year. In 2 years I would have got plus 15%, something like that. So young generation is not putting the money. So deposits are not coming easily, right? Credit growth is happening because people are spending money now. You must have heard about buy now, pay later, and all these things are coming. So credit growth is happening. So RBI did a review whether the banks need to have counter cyclical capital buffer or not, because this is a period of credit growth, and RBI said no need. Now, the framework for counter cyclical capital buffer was put into place by the RBI on 5th of February 2015. So based on the review, it has been decided that it is not necessary to activate counter cyclical capital buffer. So the banks are told no need to keep anything from 0 to 2.5% right now. We have reviewed, but RBI could very easily have told the banks you need to put anything from 0 to 2.5%. So capital conservation buffer is mandatory at all times, and it is always 2.5% of the risk-weighted assets, whereas counter-cyclical capital buffer, RBI reviews from time to time. It is not always mandatory, and we need to protect the banking sector from periods of excess credit growth. That is why the RBI asked the banks to put anything from 0 to 2.5% of their risk-weighted assets as counter-cyclical capital buffer. Now let's come to asset reconstruction companies. You know what are asset reconstruction companies? They will buy the non-performing assets from the banks, and then they will do the recovery of the same. Or they can sell these non-performing assets again to some other company. So what are the directions? See, if you want to open an asset reconstruction company, what is the minimum fund that you need? So the minimum net owned fund requirement is 300 crore. 300 crore. And it is not like 300 crore like right away. Well, you can have this requirement done by 31st March 2026. Earlier it was 100 crore by 11th October 2022. Then by 31st March 2024 it was 200 crore, and now it is 300 crore. So 300 crore is the minimum net owned fund requirement if you want to open an asset reconstruction company. But if you want your asset reconstruction company to also do resolution applications, you want to act as a resolution applicant under the Insolvency and Bankruptcy Code 2016, then your net owned fund requirement has to be 1000 crore. I repeat, see, if you want to open an asset reconstruction company, you need 300 crore minimum. That is fine. But you know there is an Insolvency and Bankruptcy Code of 2016. If an asset reconstruction company also wants to do the proceedings of insolvency and bankruptcy of a company, that is, it can act as a resolution applicant for any company. It can resolve a company. It can do the auction of the company, whatever, all those procedures, liquidation procedure. Then the asset reconstruction company should have a minimum net owned fund requirement of 1000 crore. So be very careful what are they asking. Whether they are asking the minimum net owned fund requirement for asset reconstruction company, or whether they are asking minimum net owned fund requirement for asset reconstruction company that wants to act as a resolution applicant. Okay. Another thing. Can an asset reconstruction company invest in, for example, money market mutual funds, certificate of deposits, corporate bond, commercial papers, all these short-term instruments? Can it invest? Yes, it can, but there is a cap, 10% of the net owned fund of the ARC on maximum investment in such short-term instrument. There is a cap. The maximum investment, I repeat, the maximum investment which a asset reconstruction company, maximum investment with which asset reconstruction company can do in short-term instruments like money market instruments, certificate of deposit, corporate bonds, commercial papers, all of these, it has to be maximum 10% of its net owned fund. Not more than that. It can invest into short-term instruments. And a asset reconstruction company can invest into, it can invest, if it has any surplus funds, it can invest in government securities and deposits with scheduled commercial banks, Small Industries Development Bank of India, NABARD, or any other entity which is specified by the RBI from time to time. Now let's come to action against Kotak Mahindra Bank. First of all, you need to understand under which section RBI took action against Kotak Mahindra Bank. This is Section 35A. Section 35A of the Banking Regulation Act of 1949. Why it took action against Kotak Mahindra Bank? Because its IT infrastructure was inadequate. I told you operational risk, right? So in the absence of robust IT infrastructure and IT risk management framework, the bank's core banking system and its online and digital banking channels have suffered frequent and significant outages in the last 2 years. The most recent, there was a disruption on 15th of April 2024. Now just imagine a big bank like Kotak Mahindra Bank, which has assets, deposits worth lakhs of crores. There is a server outrage. So you are trying to open the website of Kotak Mahindra Bank. It is not opening. Why? The servers are busy, servers are loaded. The core banking system is not proper, which we call IPv6. They have migrated from IPv4 now to IPv6, Internet Protocol version 6. It is not proper. All these are not forgivable in today's time and age. So under section 35A of the Banking Regulation Act 1949, the penalty was the action was taken against the Kotak Mahindra Bank because its IT infrastructure was not adequate. There were a lot of outages. The most recent outage happened on 15th of April 2024, and look, RBI was so swift. 15th April outage happened, 24th of April they put the supervisory action. So what was the action taken? The action taken was that the Kotak Mahindra Bank was stopped from onboarding new customers through both online and mobile banking channels. It was stopped from issuing fresh credit cards. You cannot issue fresh credit cards. You cannot onboard new customers. This is a big loss. This is a big loss when you cannot onboard new customers. Now, T. Ravishankar has been reappointed as the RBI Deputy Governor. Reserve Bank of India cannot have more than 4 Deputy Governors. According to the recent data released by the General Insurance Council, the premiums of the general insurance have increased to what amount in the financial year 24? This is a very tricky question. I would say this is a very tricky question, but no need to worry when I am there. I will explain to you in the best possible way. First of all, okay, tell me one thing. How many types of insurance companies are there? Now you will tell me, sir, there is a life insurance company, and then there is a general insurance company. But the problem is, okay, what is then non-life insurance company? Can I say that non-life insurance and general insurance are same? No, they are not. Yes, in normal when we talk, we say, okay, non-life insurance is general insurance, but it is not like that. General insurance is general insurance. Non-life insurance is non-life insurance. Okay, and I will explain to you the difference. So first, let me explain to you the difference between all of these. So first, I am writing general insurance companies. Okay, now general insurance companies are of 3 types. One, we have non-life insurance companies, which are 25 according to the IRDAI website. Their premium was how much in the financial year 24? So their premium was 2,45,424 crore. These are 25 non-life insurance companies. Okay. Then we have 5 health insurance companies. Now will you ask me, sir, are there only 5 health insurance companies in India? No. These are called 5 stand-alone health insurance companies, which means they offer only health insurance, nothing else. Okay, like for example, Aditya Birla Health Insurance, for example, Narayana Health Insurance, Niva Bupa Health Insurance, Star Health Insurance. These are called stand-alone health insurance companies. And how much premium they collected? So they collected 33,116 crore premium. Then there are 2 companies which are called specialized insurance companies. What are they called? Specialized insurance companies. Okay. So which companies am I talking about? So I am talking about 2 companies. One is Agriculture Insurance Company of India. It is a specialized insurance company. And one is ECGC. ECGC, which is Export Credit Guarantee Corporation of India, which is again a Government of India company, ECGC. So these 2 are called specialized insurance companies. And how much premium did these 2 companies collect? They collected 11,190 crore rupees. So all of these are called general insurance companies. General insurance companies include non-life insurance companies, stand-alone health insurance companies, and specialized insurance companies. So if I ask you what was the total premium that was collected by the general insurance sector, then you add all of these and it will become 2,89,731 crore. Or you can say 2.89 trillion rupees. 2.89 trillion means 2,89,000 crore. So this was the total premium that was collected by the General Insurance Company? So the answer of this question will be 2.89 trillion rupees. Now, another interesting thing. These 5 standalone health insurance companies used to be there, but not anymore. Now we have 2 more. So the health insurance, the standalone health insurance companies, their number has increased from 5, 2 more have been added, and now their number is 7. Now tell me, which are the two new standalone health insurance companies which have been which have been approved, or which have been given the permission to act as a standalone health insurance companies by IRDAI? Or in other words, which are the 2 new standalone health insurance companies which have been launched recently? One is Galaxy Health and the second one is called Narayana Healthcare. Narayana Healthcare. They have entered into the health insurance market, right? And which were the 5 that were earlier there? So they were Aditya Birla Health Insurance, Care Health Insurance, Aditya Birla Care Health Insurance, Star Health Insurance. We also had a company called Manipal Cigna Health Insurance and Niva Bupa Health Insurance. These 5 were there. Now 2 more have been added. So now we have 7 health insurance companies in standalone. These are called Sahi or standalone health insurance companies in India, and therefore the health insurance premium will definitely increase. And look, also the people, they are waking up now. Okay, they are waking up. Now my question to you, now you know that the general insurance companies in India, they collected a premium of 2.89 lakh crore. How much increase was it if you compare it with the previous year, financial year 23? So this was an increase of almost 13%. It was an increase of 13%, right? This can also be asked to you. This can also be asked to you as a question. Moving on. So what is the answer of this question? The answer is 2.89 trillion, because they are asking general insurers. They are asking general insurers. Which of the following bank and Standard Chartered Bank India, they have carried out the credit default swap trade worth 25 crore? Nice question, but also a question that needs to be explained. The answer is State Bank of India. Here what you need to understand is what is credit default swap trade. As the name says, first look, whenever you read something, always first see the name. Credit default. Credit default, you know, if you have taken a loan from bank and if you are not giving him back. So what is that? That is credit default. So credit default swap, which means I am worried, so I will swap my risk. I will decrease my risk. I will hedge my risk. How? So let me explain. So let's say this is you and you have taken a housing loan. You have taken a housing loan, let's say 1 crore. 1 crore from a bank. Okay, and you have constructed a nice house. You have constructed your nice house. Okay. Now this loan you need to pay back in 5 years. The complete loan plus interest. Okay. And let's say, I'm just throwing any random number. Let's say the EMI comes to be 2 lakh rupees per month. So 2 lakh rupees per month, and this is a loan that you took from Punjab National Bank. Okay. How much loan you have taken? 1 crore housing loan, and you need to pay it back over 5 years, and principal and interest both. So that EMI comes to be 2 lakh per month. So 2 lakh per month you have to pay for 5 years. Now Punjab National Bank is worried. Punjab National Bank is worried. What if you what if you escape? What if you escape? Now, okay, it is housing loan, it is still a secured loan, so they can sell your asset and recover their money. But let's say it was not a housing loan. Let's say it was some personal loan you have taken for, let's say, education loan. Okay, so education loan you took 1 crore and 2 lakh per month you need to pay for 5 years. Now PNB is all of a sudden worried that you might not give there is always suspicion, right? People can escape or loan may not come back or whatever. So what PNB says to PNB wants to decrease the risk of this loan becoming a non-performing asset. So what they do, PNB will do a credit swap deal. Credit default swap deal. Credit default swap deal with, let's say, some bank or insurance company. So they have done it with, let's say, some other bank. It is their wish. They have done it with State Bank of India. And where they say, look, I was charging this person 10% interest rate. Okay. Whatever that is. Out of the 10% interest that I'm charging, I will pay you 2%. So I will earn 8% instead of 10%, but I'm okay with that. But give me a guarantee if this person defaults. If this person defaults, then you will fulfill the entire obligation till 5 years. So SBI will say, okay, because this 2% I am earning for free. This is like a premium, just like you pay a premium to an insurance company. This 2% is a premium. So SBI will see, their underwriters will see whether to do this credit default swap or not. So this is called a credit default swap. So in a credit default swap, a bank will offload some of the risk. Yeah, yes, it is not earning 10 but 8. That is okay. PNB is happy to earn less, a little less, but at least that risk of non-performing asset, of this loan becoming a non-performing asset, is not there. So this is called a credit default swap. Now this credit default swap has been done between these two banks which I told you. Now Jammu Kashmir Bank, which is headquartered in Srinagar, they have signed a MOU with a company called PayMart to launch an innovative virtual automated teller machine facility. So this is a virtual ATM. What is virtual ATM? So how this will work, I will tell you. First, you download Jammu Kashmir Bank's mobile app called mPay Delight. This is their mobile app, and this will serve as a virtual card. Okay. So your phone is like your card. You don't need to carry the ATM card. So cash withdrawal process is initiated through the mobile app. Once the cash withdrawal process is validated by the OTP, the cash is dispensed hassle-free. The current limit for this is 2,000 rupees per transaction and 10,000 rupees per month. 10,000 rupees per month. So the merchant's smartphone with the app acts as the virtual ATM, and 2,000 rupees per transaction or 10,000 rupees per month is the cash that you can get from merchant. You don't need ATM. Merchant will give you the money. So this was launched by Jammu Kashmir Bank. Now let's talk about Union Bank of India. So they have raised 500 million, that is 4,200 crore approximate, from foreign markets to fund overseas business growth. The fund was arranged by Dubai International Financial Center, Dubai branch, UAE. So basically Union Bank of India has taken a loan of 4,200 crore from Dubai International Financial Center. They have taken this from the foreign markets. They have taken this loan from the foreign markets. Is that clear? Does that make sense? And they want to expand. India Post Payment Bank, they have introduced the Aadhaar ATM service facility for their users. It works on the principle of Aadhaar enabled payment system that was introduced by National Payment Corporation of India. So India Post Payment Bank online Aadhaar ATM facility will enable the customers to avail cash without visiting a bank or a ATM, and simply avail cash at their doorsteps with the help of a postman or Gramin Dak Sevak. So a postman or Gramin Dak Sevak will come to you with a machine, and then you can, then this is like a ATM at your doorstep, Aadhaar ATM. So, but there is a maximum transaction limit of 10,000 on a single AEPS financial transaction. Aadhaar enabled payment system financial transaction, 10,000 maximum transaction amount limit is there. And you can do other things also, not only withdraw cash, but you can also do balance inquiry, cash withdrawal. This is all the feature of Aadhaar enabled payment system. You can also have a mini statement. You can also make a cash deposit. Which of the following company has become the first foreign insurance company, first foreign reinsurance company to open their office in the Gift City in Gujarat? It is Alliance Partners, which is based in France. Now look, Allianz is originally a company from Germany, but Alliance Partners is based in France. So they have launched IFSC Insurance Office in International Fintech Services Center, IFSC Gift City in Gandhinagar. They are the first foreign reinsurance company to open their office at IFSC. Moving on now. Which of the following state is leading in tree plantation under Green Credit Program? Green Credit Program, the answer is Madhya Pradesh. Madhya Pradesh also has the highest forest cover in India. So in Madhya Pradesh, 500 land parcels, they have been approved for tree plantation. So Madhya Pradesh is leading. Madhya Pradesh is leading, and total 10,000 hectare of land is where tree plantation will be done in the entire country. Madhya Pradesh, in Madhya Pradesh, the highest is there. Out of 10,000 hectare, 954 hectare is there in Madhya Pradesh. Green Credit Program. And 14 public sector companies and entities, they have been registered to carry out plantation on the degraded forest land and earn the green credits. Green Credit Program was launched on 13th of October 2023, and it basically incentivizes environmental actions. So it is an innovative market-based mechanism which is designed to incentivize voluntary environment action. Voluntary environment action. So there are a lot of things that you can do and you will get environment credits. You will earn green credits. You will be incentivized to do good for the environment. Who among the following has been appointed as the Managing Director of International Monetary Fund? So Kristalina Georgieva from Bulgaria has been reappointed as the Managing Director of International Monetary Fund for a 5-year term. Her new term starts on 1st of October 2024. So she will remain the Managing Director till 1st October 2029. As per the recently released World Economic Outlook, which is the main report of the International Monetary Fund, global growth has been estimated at what percentage in 2024? Global growth will be 3.2% in 2024 and same in 2025. 2025. Now, what about India? So, India's growth rate will be 6.8% in 2024 and 6.5% in 2025. So, it is attributing robust growth for India. Robust growth for India. As per recently released Trade and Development Report update for April, India's economy is forecasted to grow at what percent? This is given by UN Trade and Development, UNCTAD, headquartered in Geneva. So India's growth rate, according to this, will be 6.5% in 2024. According to United Nations Conference on Trade and Development, which now they call simply UN Trade and Development. And global economic growth rate, according to them, will be 2.6% in 2024. According to SBI Economic Research Department, total amount of deposits in senior citizen accounts has increased to what at the end of December? Total amount of money in the senior citizen account, how much it is? It is 34.367 lakh crore. So this, deposits have increased by 143% at the end of December. At the end of December, if you compare it with the end of December 2018. So in the last 5 years, they have increased by 143%. 143%. So they were 13.724 lakh crore at the end of December 2018. 13.724 and now they are 34.367. The growth is 143%, right? And there is a huge growth seen in the saving accounts deposits as well as the term account deposits, both. So this shows the the success of senior citizen saving scheme. Also in senior citizen saving scheme, the amount that you can deposit was increased from 15 lakh to 30 lakh. So now it is 30 lakh and it is getting an attractive 8.2% interest rate as well. 8.2% interest rate you are getting in the senior citizen savings scheme right now, and you will keep getting it till for the next 3 months, and then of course government will revise it. It can be same, it can be different, we'll see then. So senior citizen saving scheme. As per the recent study conducted by the scientists at Potsdam Institute for Climate Impact Research, Germany, global economy could face annual losses of up to what amount by 2049? Global economy could face annual losses of up to $38 trillion every year because of the climate change. These are the economic consequences of climate change. $38 trillion, by 2049. That is because of the climate change. Which of the following company has launched its first edition of Ideation X? Ideation X, it was launched recently by SBI Life Insurance Company. What is Ideation X? Ideation X is a competition that aims to transform the future of the insurance industry. We know that we need insurance for all by 2047. This is the vision. So they want to encourage and engage the young aspiring minds, students from the B schools, to come up with new ideas, new innovative solutions to the problems. And more than 1000 candidates, they participated in the first edition of Ideation X. More than 320 schools they participated. And which was the winning team? XIME Bangalore was the winning team. XIME Bangalore was the winning team. Is that clear? Who among the following has written the book Just a Mercenary, Notes from My Life and Career? So this book is written by P. Subba Rao, the former governor of the RBI. He was the 22nd governor of the RBI. He was the governor from 2008 to 2013. And I have got a personalized book from him. So that was a very honorable moment for me. As per recently released report called Space, the 1.8 trillion opportunity for global economic growth by the World Economic Forum, space economy is projected to reach $1.8 trillion by which year? So this will be 2035. Currently, if you talk about the space economy of the world, it is $630 billion in 2023. It will become 3 times. It will become 1.8 trillion by 2035. 2035. So that was the video for banking awareness, 3rd week of April. I'll see you in 4th week video. Thank you for watching Study IQ.